The hidden wealth drains most investors miss. Throughout my years of working with business owners, I've noticed a pattern that never ceases to surprise me. The most significant threats to wealth aren't always the ones that make headlines. While market volatility might grab attention, the silent, persistent factors truly erode wealth over time. Understanding these hidden wealth drains is critical, especially for business owners navigating personal and business finances. Tax planning, the most overlooked wealth protector. If I had to identify the single most significant factor impacting my clients' long-term wealth, it wouldn't be market performance or even business growth. It's effective tax planning. But calling it overlooked doesn't quite capture the situation. The reality is more complex. There are dozens of tax credits and deductions available to business owners that most CPAs don't discuss with their clients. This is not necessarily because these professionals are deliberately withholding information. They often lack the bandwidth to explore these opportunities thoroughly. Many CPAs don't have time to learn about specialized credits and deductions, and they may also not have sufficient staff to handle the additional work. This creates a gap that directly impacts business owners' wealth. Instead of finding strategic partners to maximize tax advantages, business owners leave money on the table, sometimes tens of thousands of dollars annually. Through proper planning, I've seen clients recover $30,000, $40,000, or even $60,000 from the IRS. I don't know any business owner who wouldn't want that money returned. This oversight becomes particularly costly when planning for a business exit. Without proper preparation, the tax burden from selling a business can significantly reduce the owner's retirement nest egg. Strategic tax planning isn't just about annual savings. It's about preserving wealth at critical transition points. Cash flow management. The foundation of business wealth. Cash flow management is the second most significant wealth factor that often goes unoptimized. This relates directly to tax planning. When business owners don't take advantage of available tax incentives, they have less cash flow for growth and investment. I frequently see businesses making several critical cash flow mistakes. Over-leveraging debt or extending too much credit to customers creates misalignment when accounts payable become due. This misalignment can lead to cash flow challenges when paying business bills before collecting from customers. Another common misstep is not maintaining sufficient liquidity for unexpected downturns or opportunities. Understanding the timing of debits and credits is critical to managing growth and the business's ultimate value. What's not immediately obvious to most business owners is how interconnected all these variables are. Proper tax planning preserves cash in the business. More free cash allows for reinvestment into operations, hiring that key salesperson, technician, or CFO who could take the business to the next level of value in the market. The two economies, how inflation erodes business wealth. Many people don't understand that there are effectively two economies operating simultaneously. The market economy dominates news headlines and uses the S&P 500 as its benchmark to assess broader market performance. Then there's the real economy, the daily exchange of goods and services directly affecting business owners. While inflation impacts both economies, it hits the real economy much harder. As a business owner, you face a delicate balancing act when inflation affects the goods your business needs. When margins get squeezed because costs increase, difficult decisions follow. Do you raise prices and risk losing customers? Delay hiring that needed help? Postpone your retirement contributions? These aren't just business decisions. They're wealth decisions with long-term consequences. This inflation pressure creates additional complications for business exit planning. As inflation slowly erodes margins, optimizing the business for a successful exit becomes more challenging. The value of your business, often your largest wealth asset, becomes vulnerable to these economic forces. Technology. Adapt or fall behind. Artificial intelligence is the most significant technology currently reshaping business. Companies that don't find ways to adopt AI at some level will struggle to produce the growth they need to remain competitive and valuable. I have met with accounting professionals still managing their client databases from Excel spreadsheets, an approach that creates enormous inefficiencies. Dozens of platforms can help professionals streamline communications and stay top of mind with clients. This technological lag doesn't just affect operations, it directly impacts business value. Technological obsolescence creates a double threat for business owners. It diminishes current operational efficiency while reducing the business's eventual sale value. Both factors directly impact personal wealth accumulation. Healthcare costs, the hidden business expense. One way businesses stay competitive in recruiting employees is through their benefits package, with healthcare being a central component. Since healthcare often represents a company's second largest expense, rising costs can prevent hiring additional talent needed for growth. For business owners, this challenge affects both business operations and personal wealth planning. Every dollar allocated to rising healthcare costs is one less dollar available for business investment or personal wealth accumulation. Lifestyle creep. The personal piggy bank problem. The most practical approach for helping business owners maintain financial discipline is addressing a fundamental mindset, not treating the business like a personal piggy bank. Business owners must operate as CEOs, receiving reasonable salaries aligned with their duties and the company's needs. However, I consistently see business owners using their companies as extensions of their personal finances. They watch revenue increase year over year, yet can't understand why their business is cash poor. Often, this occurs because their CPA isn't providing the data needed to show how the business functions as a personal piggy bank. This lifestyle creep creates a wealth illusion, the appearance of prosperity without the substance of actual wealth accumulation. Revenue growth doesn't automatically translate to wealth growth when personal spending increases proportionately. Small leaks sink great fortunes. The compounding effect of these wealth erosion factors creates a significant impact over time. Beyond tax optimization, I see businesses never evaluating their healthcare plans or property and casualty insurance policies. Insurance companies raise rates annually, and business owners approve the increases without question. These seemingly small decisions can cost tens of thousands of dollars monthly. Fuel costs alone can represent substantial unnecessary expenses for businesses with vehicle fleets. A proper cost reduction specialist can highlight these leaks and transform them into wealth-building opportunities. The coordinated team approach. Bringing together a cohesive team of financial professionals, including CPAs, tax strategists, estate planners, business attorneys, investment advisors, and insurance specialists creates protection against wealth erosion in ways traditional wealth management often misses. A collaborative financial team provides a comprehensive defense through proactive tax planning versus mere tax preparation, cash flow optimization, exit and succession planning, diversified retirement and investment strategies, legal and risk mitigation, management of compensation structures, estate planning to prevent tax drains, strategic insurance planning, and business expansion strategies. By integrating a team of professionals, business owners gain a multi-layered wealth protection strategy that anticipates risks, optimizes opportunities, and ensures that every financial decision aligns with long-term financial security. First steps toward wealth protection. If you're ready to address these wealth erosion factors, the first step is clarifying your business's financial health. Meet with a CPA and consider engaging a fractional CFO to review your P&L statement, balance sheet, and cash flow to identify where money is leaking from your business. Determine your company's current valuation to structure a plan for improvement. Then assemble the financial team to work together to execute the plan, reducing cash leaks, increasing company value, building tax strategies, and establishing a clear exit plan, overcoming resistance to change. The biggest misconception I encounter when discussing these wealth erosion factors is that business owners believe their CPA is more than they are. Despite evidence to the contrary, many remain loyal to their existing financial advisors. My approach isn't to encourage firing current advisors. I'm happy to work with existing CPAs if they don't restrict progress. If they do, business owners eventually see this themselves and typically ask for referrals to new professionals. The shift in perspective comes naturally through education and by illuminating the dark corners of their financial lives. The more I illuminate these hidden wealth drains, the more business owners recognize the need for a comprehensive approach to wealth preservation. Understanding and addressing these wealth erosion factors isn't just about preserving what you've built. It's about creating the foundation for true financial security and freedom. The business owners who thrive long-term recognize that wealth management extends far beyond investment returns to encompass every financial decision they make, both in business and life.